Hello everyone. I wanted to go through the calculation of performance using the DuPont analysis for JB Hi-Fi. We're going to do this in two ways. We're going to use the traditional DuPont analysis, then we're going to use an alternative methodology where we separate out our income statement and balance sheet items into operating and financing. We'll see what the difference is between the two of them. You can get the original data that I'm going to be working off on the Google Sheets that I have linked to in the video below. So this is going to be our setup here. Traditional DuPont, then alternate DuPont. We're taking in our information from the income statement items, and at the bottom, what you can see we're doing here is we've separated out our income into operating profit and interest expense. So we've got net operating profit after tax and net interest expense after tax. And you can see how these calculations have been done by looking at the formulas here. We do this because this allows us to get an understanding of the performance of the operating activities separate from the way in which they've been financed. So that might be important depending on the nature of the business that you're looking at. If your business doesn't have any debt, for example, or doesn't have a large amount of financing items, then that distinction will be less important. For organizations like financial services organizations, that also will be less important. You can see we've done the same thing on the balance sheet. We've separated out our balance sheet items down the bottom here into operating items and then into the way in which they've been financed. And the way we've done this here is really, if it's financing, it's either shareholders' equity or it's part of debt. So net debt, I've got a short-term debt, long-term debt, less cash. If it's not any of those, then it's not considered financing. So the operating activities more or less picks up everything else other than the financing activities. I've collected all of those into a tab here that we've got variables. You can see that in some cases I've got average equity or average assets. The reason being is that I'm going to be calculating some ratios here, and in the balance sheet we're going to be using the average value. So the average is the start of year value plus the end of year value divided by 2. And so that's getting the average amount of equity that was in place over the year, or the average amount of assets that was in place over the year. And it's just commonly used by analysts when they're measuring ratios that involve some flow measure, something off the income statement or a cash flow statement, and an associated balance sheet measure. So that's what we'll be doing. Okay. Let's have a look. As a starting point, let's calculate return on equity. So return on equity, net income, it's going to be an after-tax measure, and we'll be using average shareholders' equity. So let's see what we've got. I'm going to go to my variables tab, and I've got, starting in 2016, net income divided by average equity, and we can probably treat that as a percentage is probably going to be a little bit nicer. 40.7%. Let's decompose this into the DuPont components, which is profit margin, so how profitable the sales were, asset turnover, which gives us a measure of the efficiency with which managers have been using total assets, so what level of sales are they able to generate for each dollar of assets, and leverage, the extent to which there's financing in the capital structure. So there's some of the levers that you've got to pull as managers to try and adjust firm performance. And if we're analysing performance, then we can use those levers to try and determine where overall performance, as measured by something like ROE, has changed. So let's have a look. Net income over sales is what we've got. Let's go to our variables. We've got net income and divided by sales. Once again, let's make that a percentage. And asset turnover is sales, so the level of revenue that I've got, divided by the average amount of assets in place. So this is telling me that the firm's able to generate $4.2 of sales for each dollar of assets in place. That's a relatively high measure, but again, we're thinking here about JB Hi-Fi, a retailer that's trying to turn its inventory over a lot, so the numbers make sense on that basis. The leverage measure that we've got, average assets divided by average equity, or in other words, the extent to which we've got borrowing in the financing structure. And there are three components. What we now want to do, just to check that we've done this calculation correctly, I'm going to multiply those three together. Profit margin times turnover times leverage. And we can see here we should get net income. The sales should cancel out. Average assets should cancel out. So we should be left with net income over average total equity. Okay, and we've got the same number that we had started with earlier. So I'm kind of happy with that. Let's just center that to make that look a little bit nicer. What I can now do is drag that across, and I've got my return on equity and its component measures for JB Hi-Fi for the last 6 or 7 years. And again, what this allows us to do is determine if we see a change in ROE. So during 2021, 2022 and the pandemic, there was a large increase in ROE. We can see where that's come from, and we can see here that, look, it looks like it's being driven primarily by an increase in profit margins. So even though times were tough for the retailers, people were still, in JB Hi-Fi's case, spending particularly on the work from home items, and in some cases they were shifting, because they were shifting from, say, general our phones, laptop, to larger work from home stuff. There could have been an increase in profit margins. Also, the supply chain issues meant that there was less discounting, in particular less on the floor discounting that you often get at an organisation like JB Hi-Fi. So that's our traditional DuPont decomposition. Let's see how it differs if we're looking at this alternate DuPont decomposition. So our profit margin measure, rather than using net income, is going to be using NOPAT, or net operating profit after tax. So we'll start off with net operating profit after tax divided by sales. Again, let's just get that in as a percentage. Our operating asset turnover differs from total assets turnover. So here we're saying what level of sales were they able to generate for each dollar of net operating assets. So that's operating assets less operating liabilities. So a slightly different measure to total assets turnover, where we're looking at all assets on the balance sheet and their capacity to generate sales. These two measures multiplied by together. So our net operating profit margin multiplied by our operating assets turnover gives us the return on net operating assets. So return on net operating assets, which is going to be similar to a return on invested capital measure, because the invested capital is going to be used to purchase the operating assets. So 34.5%. So this is the RNOA, return on net operating assets. The next measure we want is going to be the after-tax cost of debt. Now we're going to measure that by the net interest expense after tax divided by the average amount of net debt that we had in the balance sheet over the year. So our net interest expense after tax divided by the average net debt. And let's turn that into a percentage. So this is their after-tax borrowing cost, and we can kind of just see if that number seems plausible. 3.5% as an after-tax borrowing cost for JB Hi-Fi. This strikes me as in the plausible range. The reason we do this is that we now calculate the difference between the profitability of the operating assets and the cost of money that we're using to borrow to help fund those assets. So the difference between those two is what we call the spread. So the spread we calculate as RNOA less the after-tax cost of borrowing. And if you're running a business, you want this to be positive. This says that the profitability of your operating assets is higher than the borrowing cost to fund those assets with debt. So this means that using debt is kind of a good idea. It will increase the returns to shareholders. We then want to get a sense of how much debt, or net debt more precisely, is going to be in the capital structure. So rather than average assets over average equity, we're now going to use a measure of average net debt divided by average equity. And I can make that as a percentage. So we've got this notion of spread multiplied by the financial leverage will give us our financial leverage gain. Okay, and we can increase that by a percentage if we need to. So what we now get is that we've got the profitability of the operating assets, the RNOA, and we've got the extent to which borrowing is working in our favour. That is, the operating asset profitability is higher than the cost of net debt. So we add those two together. So the RNOA plus financial leverage gain gives us our 40.7%. Now, that matches the 40.7% that we calculated during the traditional DuPont decomposition. And that's important. Return on equity won't change depending on the way in which we do the decomposition. All that we're doing here is a separate way of working out the component parts. So once again, let's make that even, and let's just drag that across. So again, what we're doing is we can see, so looking again, what's the story that we're getting here? In this case, we can see it's the operating profit margin. So the NOPAT margin was increasing. The operating asset turnover also increased a little bit during the 2021-2022, the pandemic period. One reason for that is the increase in online sales relative to in-store sales during the lockdown, and online sales require less hard assets, so less physical store presence. So that's one reason why we might expect the operating asset turnover to go up relative to, say, the total asset turnover. So what we can see overall is let's just check our after-tax cost of net debt. It's kind of bouncing around the 3, but the 3, 4, 5%. Again, you just want to eyeball that and see if that seems plausible as borrowing cost for your organization. But again, what we've got here is separating out the operating and the financing components of performance allows you to get a better sense of how profitable the underlying operations are. And that's going to be important because that's what we want to forecast going forward. So to what extent can the business make money out of the operations? Again, and then what will we do with this? Well, for those that don't like just looking at a spreadsheet full of numbers, you probably want to create a chart out of that, and so you can just more easily kind of visualize what's happened to financial performance over time.